Well, you hear about the federal funds rate in news headlines, but what does it mean for you and me? Troy Sutton breaks it down in this week's KTAB Financial Friday.
I remember walking into a crowded bank one day and wondering, if bankers can count, how come there are 8 windows and only 2 tellers? I heard a comedian once quip, "I asked my bank manager how to start a small business. The manager thought for a moment and then replied, well, start a large business and then wait 6 months. The Federal Reserve, which is the central bank for the United States, voted in their July policy meeting to lower the federal funds rate from 0.25 or by 0.25% to range between 2 and 2.25%. Now, that's the first time in over a decade, or at least since the 2008-2009 Great Recession, that rates have been lowered. Investors cheered the decision. But what does this mean for the average American? Well, first of all, what is the federal funds rate? That's the interest rate the banks charge other banks for lending them money from their reserve balances on an overnight basis. Reserve amounts are set by the Federal Reserve Bank to guard against bank failures. It's the amount of money, so to speak, the bank has in the vaults. If a bank has more money in their reserves than necessary, that bank can loan that excess to other banks who might have a shortfall. Now, they charge interest for that, and that's set by the Federal Reserve, or at least a range. The Federal Open Market Committee, which is the monetary policy-making body of the Federal Reserve System, meets 8 times each year to set the federal funds rate. They make their decision about rate adjustments based on economic indicators like inflation or recession, etc. And in the face of growing economic uncertainties like the fallout from the U.S.-China trade war, growing global economic or slowing global economic growth, and Brexit, the Federal Reserve seems to be cautious. Now this rate, the federal funds rate, is one of the most important interest rates in the U.S. since it affects financial conditions, which in turn affect the broader economy to include inflation, employment, growth, and more. It also affects everything from home and auto loans to credit cards. In short, if you're wanting to borrow money, a Fed funds rate reduction can help you get a lower cost to your mortgage or your refinance or your auto loan and so forth. The other side of the equation, though, is that savers don't earn as much. So good for borrowers, bad for savers. In one of the endowment funds that I manage, they used to keep $1 million in a bank CD at 5%. This $50,000 of interest every year was plenty for them to pay various expenses. But when CD rates dropped after the recession to 0.5%, that $5,000 of interest didn't go nearly as far as $50,000. Good for borrowers, bad for savers. The typical effects of a low federal funds rate is a low interest rate environment for businesses and consumers, it's you and me, relatively higher inflation, and a stimulated employment opportunity. Better job growth. This is called expansionary monetary policy. Expansionary monetary policy by the government in an effort to pump more cash into the economy to be used, to be invested, and to spur growth. So the bottom line, though you won't probably feel any dramatic effects on your personal lives, interest rates will eventually go higher. So right now, while they're low, it is important to reduce your debt in these good times so you won't feel overburdened in a higher interest rate environment. Remember, bankers never die, they just lose interest. Have a great week.
All right, thank you, Troy. If you would like to contact Sutton Financial Group, they are located at 2449 South Willis and Suite 106. You can give them a call at 437-0709 or go to suttonfinancialgroup.com.